In today's video, we are breaking down one of the most important conversations happening in the market right now. Dan Ives, the global head of tech research at Wedbush Securities, lays out why he remains bullish on artificial intelligence, even as tech has become the worst performing sector so far this year. He explains what is really driving the sell-off, which companies he is actively buying, and why he believes Microsoft could be a once-in-a-generation opportunity at these levels. The key question he tackles is simple but critical. Is this fear creating opportunity, or is something bigger breaking in tech? First, I am going to show you the actual clip of Dan Ives speaking so you can hear his perspective directly. After that, I will walk you through my own detailed reaction and breakdown of what he said, what I agree with, what I question, and what I think investors need to understand right now. Then I will finish with an in-depth analysis of two AI stocks I believe offer a better risk-reward setup than Nvidia at this stage. Hit the like button and let's push this video to 1,000 likes. Share it with anyone trying to make sense of this market, drop your thoughts in the comments, and subscribe to the channel so you do not miss the next important investing update. Let's hear what Dan Ives has to say.
Tech is the worst performing sector so far this year. Is this just a pause or a crack in the AI trade? Let's bring in Dan Ives, Managing Director and Senior Equity Research Analyst at Wedbush Securities to discuss. Dan, always good to have you. I know you're well known for saying the AI party is just getting started, but it feels like the party is getting broken up here. Did someone call the cops? Is the AI trade actually cracking?
Look, I mean, there's some glass on the dance floor right now. Maybe the DJ stopped playing a little music. Look, Carolyn, I think there's a combination of things that are worrying investors. I think one, we've had a tech earnings season that's robust relative to the numbers, but obviously a lot of the sort of ebbs and flows relative to CapEx and monetization, that's worried investors. I think the Nvidia OpenAI soap opera has definitely added to some of the agita. And then look, part of it is, I think what's happening here, we're almost having a mini DeepSeek moment, going back to a year ago. A moment where investors feel like, okay, it's cracking, the trade is really starting to, almost blossom into something that's become a storm. I disagree. I think this is actually much more of smoke, no fire, bark worse than a bite relative to just massive monetization and spending that we actually see playing out in front of us.
This doesn't test your bullishness at all, though? It doesn't make you worried at all to see such a negative performance so far this year?
Oh, it does. I mean, look, I had, 2 hours sleep the last 2 nights. I mean, the point is, like, I'm talking to clients that I haven't talked to probably in 10 years, just given the nervousness. I mean, some palpable sort of nervousness out there. But look, I've covered tech going back to late 90s. Clients need me in times like this, not when stocks are going up and to the right. But I just view it like this. If I talk, but I was just gonna say, like, if I'm tracking 50, 60, 70 deals, and those deals on the enterprise are accelerating, no one's stopping. We've actually seen acceleration in terms of strategically a lot of the AI projects. All of our Asia checks are showing demand and supply calling anywhere between 10 to 12 to 1 for Nvidia chips. Like, the point is, I get the nervousness, but that's what I focus on, the fundamental checks, rather than just looking at the tape and having that get me nervous.
What is it that keeps you up at night, though? What's something that could derail this rally?
What keeps me up at night is the growing pressure on these companies, from Nvidia to OpenAI to Oracle to Google to Microsoft, in terms of CapEx. And the worry that investors are just growing increasingly concerned about what this all means from a CapEx perspective. The thing that concerns me is, does that in any way slow down the pace of AI spend? I don't believe it does. I think these companies, to some extent, I come out of earnings season more emboldened that this AI revolution is hitting its next stage of growth. But the pressure that's on the companies, I actually think it's causing more transparency. Look at Oracle. They laid out 45 to 50 billion. They showed their plan, how they're going to spend, how they're going to raise money. That's what you want to see.
Well, you mentioned Oracle. Software stocks are really getting hammered on fears that AI will essentially make them obsolete. We're seeing names not just like Oracle, but ServiceNow, Salesforce, Snowflake down almost 30% in 2026. Are any of those fears warranted, or do you look at that as a generational buy? I guess which software names are clear winners and which are most at risk?
Yeah, so to answer, and it's a great question, I'd say, is AI a near-term headwind for software? Yes. Is AI structurally ruin the sector? No. I essentially think, like, baked into some of these valuations, you have to assume Salesforce loses 10, 15% of their customer base. You have to assume ServiceNow numbers go down 20% from where the street is today. What I'm saying is, like, this is an Armageddon like trade right now for software. And I can tell you, going back to the late 90s, I have never seen a sector structurally thrown into the garbage like this in all my time. Now, there have been times dot-com bubble and burst, financial crisis, but the software sector is basically trading like it's structurally broken. And I strongly disagree with that view. And that's why I think, like, Salesforce, Microsoft, we talk about Oracle, CrowdStrike, some of the cybersecurity names, I think are the ones that you own along with Microsoft.
So for investors sitting on the sidelines right now, is this the moment to buy, or is it best to be patient for a bit and see how this plays out?
No, I think this is, in a year, you get 4 or 5 opportunities. Like, I go back to last year, the DeepSeek moment, Liberation Day, some of the geopolitical issues, over the summer and then maybe into the fall with Fed. This is the moment. Like, there, to me, it is a clear buying opportunity to own the winners if you actually have a time horizon more longer than a few weeks, a few months. I mean, in other words, like, you're looking at, we're in year 3 of an 8 to 10 year build out for AI revolution.
Year 3. Okay, so we had Alphabet report last night, failing to impress. I think that CapEx number maybe scared some investors off. It's down 4%. Amazon is out after the bell today. Anything that they can do to change this narrative?
Look, Google being down on this number is, I think, a top 5 most anomalous move that I've seen going back to the last year. Like, like Google right now should be up, given those numbers, given CapEx. You want to see them aggressively spend. If they're not, you want to see them on the offensive. And when it comes to Amazon, like, you'll see more of that. What they're going to talk about in terms of, like, AWS growth, they got to keep pace with Google. You got to keep pace with Microsoft. And I continue to think, like, there's really no AI premium that's being factored into the Amazon story.
Microsoft is the worst performer of the Mag 7 so far this year. If you could only buy one dip for the Mag 7, which one would it be?
It's Microsoft. I think that's the one, like, generational opportunity. Like, if I look over the next, like, 12, 18, 24 months, we'll go back to this interview and we'll be like, that was a massive opportunity with Microsoft. Can it go lower?
So this,
of course. But it's my view, like, is this a stock that goes to 500, 600? Yes.
okay, so just finally, what advice do you give retail investors right now as they try to navigate the volatility and the noise in tech, but also knowing that you're saying that this is the DeepSeek or the Liberation Day moment that, I think a lot of people wish they would have bought into?
Look, I think it's a nervous time. And I think you have to be able to focus on the winners and playing this AI revolution over the coming years. You cannot get caught up, whether it's technical, the crypto sell-off, what we're seeing with just risk assets, because otherwise I think when you lose that discipline, that's how I think a lot of investment mistakes are made. That's why I think you have on your board your winners, the names you wanted to buy, the opportunities to buy them. Structurally, you actually feel better about the AI trade today than before earnings season. And that's our advice to investors. I mean, this is not the time to panic. It's the time to actually start to build positions in some of these names.
Okay, and still think what, 25% returns for the Nasdaq this year?
That is a firm view, and nothing that's happened from our checks, what we've seen in Asia, what I saw in Davos, talking to obviously a lot of companies, what I saw at CES, what I see talking to software companies, tech companies throughout earnings in any way makes me move off that number.
Okay. And finally, because you came on in January and gave your top 5 stock picks for AI, what are your top 5 now that we've seen some of this carnage?
The same 5.
Okay. So, those 5, I'm looking back at my notes here.
Apple,
Palantir, Tesla, Microsoft,
Tesla,
Apple, CrowdStrike.
Microsoft, and CrowdStrike, yeah.
The interview really kicks off with a pretty uncomfortable truth. Tech is the worst performing sector so far this year. That alone is enough to shake confidence, especially when tech has been the backbone of market leadership for years. And naturally, the big question becomes whether this is just a temporary pause in the AI trade, or whether something deeper is breaking. The host frames it almost like the AI party is getting shut down, and honestly, that is exactly how a lot of investors are feeling right now. Dan Ives responds in a very Dan Ives way. He uses this metaphor about glass on the dance floor and the music possibly stopping, but the key takeaway is that he does not believe the party is over. He acknowledges the fear, but he frames it as noise rather than a structural problem. From my perspective, I actually agree with him here. When markets get nervous, they tend to exaggerate risks before real damage shows up. And right now, what we are seeing looks more like anxiety than collapse. He lays out 3 main reasons investors are spooked. First, earnings. Tech earnings have been solid but not perfect, and the market is laser-focused on capital expenditure and monetization. Investors want to see how all this AI spending turns into profits, not just growth stories. Second, the Nvidia and OpenAI drama, which adds uncertainty and makes people question the stability of the AI ecosystem. Third, there is this broader fear that the AI trade is cracking the same way other hype-driven trades have cracked in the past. Dan pushes back hard on that last point. He says this is smoke, not fire. That phrase really matters. His argument is that this is not a speculative bubble popping, but rather a massive modernization cycle that is still in its early innings. Personally, I think that distinction is critical. A bubble is driven by weak demand and hype. What we are seeing here is demand that is actually overwhelming supply, especially when it comes to chips. When asked directly if this market action tests his bullishness, Dan is refreshingly honest. He admits he is worried. He talks about sleeping 2 hours a night and hearing from clients he has not spoken to in a decade. That tells you how intense the fear is right now. But what I respect here is that he does not let emotions override his process. He emphasizes that he focuses on fundamental checks rather than staring at stock charts. This is where his conviction really comes through. He talks about tracking dozens of enterprise deals and seeing acceleration, not slowdown. Companies are not pulling back on AI projects. They are leaning in. His checks show Nvidia chip demand running 10 to 12 times supply. That is not what a cracking trade looks like. That is what an overheated demand cycle looks like, and there is a big difference. From my own point of view, this is one of the most important insights from the entire interview. Markets can sell off even while demand accelerates. That disconnect is usually where long-term opportunities are born, not where trends die. Then the conversation shifts to what actually keeps him up at night, and this is where things get more nuanced. Dan points to capital expenditure pressure. Investors are worried that companies like Nvidia, Microsoft, Google, Oracle, and OpenAI are spending too much, too fast. The fear is that these massive investments might not pay off quickly enough, or worse, might eventually slow down. Dan does not think AI spending slows, but he does acknowledge that pressure is real. Interestingly, he sees this pressure as a positive in one sense because it forces transparency. He brings up Oracle as an example, laying out $45 to $50 billion in spending and clearly explaining how they plan to fund it. In my opinion, that transparency is exactly what the market wants right now, even if it does not immediately reward it. Next, the interview dives into the brutal sell-off in software stocks. Names like Salesforce, ServiceNow, Snowflake are down dramatically, and the narrative is that AI will make them obsolete. Dan calls this an Armageddon trade for software, and honestly, that description feels accurate. These stocks are being priced as if their businesses are permanently broken. He strongly disagrees with that view, and I do too. For the current valuations to make sense, you have to assume massive customer losses and revenue declines that simply are not showing up in real data. Dan points out that in decades of covering tech, he has never seen software treated this harshly outside of major crises like the dot-com bust or the financial crisis. That should tell you how extreme sentiment has become. He argues that AI is a near-term headwind for software, not a structural death blow. Over time, the companies that integrate AI effectively will be stronger, not weaker. That is why he highlights names like Microsoft, Salesforce, Oracle, CrowdStrike, and cybersecurity companies as long-term winners. From my perspective, this is where patient investors separate themselves from reactive ones. When asked whether investors should buy now or wait, Dan is very clear. He says that each year you get a handful of true opportunities, and this is one of them. He compares it to previous moments of panic when buying felt uncomfortable but paid off massively later. His core argument is that we are only in year 3 of an 8 to 10-year AI build-out. That timeline matters. If you are investing with a multi-year horizon, this volatility is noise. The discussion then moves to big tech earnings and capex fears, especially around Alphabet. Dan calls Google's sell-off one of the most anomalous moves he has seen in the past year. He argues that aggressive spending should be viewed as offensive strength, not weakness. I personally agree here. In transformative cycles, the companies that hesitate often lose. Spending is not the enemy if it is strategic. Amazon comes up next, and Dan points out that AWS growth and AI investment are still underappreciated. He even suggests there is no real AI premium priced into Amazon yet. That is an interesting take and one I think the market may eventually have to reckon with. Then comes the question everyone wants answered. If you could only buy one dip in the Magnificent Seven, which one is it? Dan does not hesitate. Microsoft. He calls it a generational opportunity and suggests that in 12 to 24 months, this moment will look obvious in hindsight. He even throws out price targets in the 500 to 600 range. Whether you agree with those numbers or not, the conviction is clear. Finally, Dan offers advice for retail investors navigating this chaos. His message is discipline. Focus on winners. Ignore the noise. Do not let technical moves or short-term risk asset sell-offs shake you out of long-term positions. He actually says he feels better about the AI trade today than before earnings season, which is a bold statement given the carnage. He closes by reaffirming his belief in a 20 to 25% return for the Nasdaq this year and sticks with his original top 5 AI picks: Palantir, Tesla, Microsoft, Apple, and CrowdStrike. No changes despite the volatility. My overall takeaway from this interview is that fear is dominating narrative, but not fundamentals. Dan Ives is not blind to risk, but he is anchored in demand, data, and long-term cycles. I do not think this is a moment for blind optimism, but I also do not think this is a moment to panic. If anything, this feels like one of those uncomfortable transitions where weak hands exit and long-term capital quietly positions itself. And like Dan says at the end, turbulence is part of the journey. This is where you buckle your seatbelt, not jump off the plane. Now let's dive into the 2 AI stocks to buy now that's better than Nvidia, in my opinion. Let's start with the first company, Advanced Micro Devices, better known as AMD. Before we talk about stock price or financial metrics, it is important to understand why AMD matters in the AI conversation. AMD designs high-performance computing chips that are used across data centers, cloud infrastructure, and enterprise systems. These are not consumer gadgets. These are mission-critical components that sit at the heart of modern computing. In the AI world, computing power is everything. Training large language models and running inference workloads requires enormous amounts of processing capacity. For years, Nvidia has dominated this space, but the reality is that hyperscale customers do not want to rely on a single supplier for something this important. Vendor diversification is not optional at this scale. It is a strategic necessity. That is where AMD comes in. AMD has spent years investing heavily in its data center and accelerator roadmap. Its AI-focused products are now competitive enough that large customers are willing to deploy them alongside Nvidia hardware. This is a crucial shift. Once a company proves it can operate reliably in production environments, adoption tends to expand quickly. What makes AMD especially interesting is that it does not need to overtake Nvidia to succeed. The overall AI market is growing so fast that even a modest increase in market share can translate into massive revenue growth. This is a classic case where the market opportunity is expanding faster than competition can compress margins. From a business standpoint, AMD also benefits from diversification. In addition to AI accelerators, it generates revenue from CPUs, embedded systems, and custom chips. This diversification provides resilience during cyclical downturns while still allowing the company to participate in long-term secular trends like artificial intelligence. Financially, AMD has already started to reflect this momentum. Revenue growth has accelerated meaningfully, and profitability has improved as higher margin products become a larger portion of the business. That is an important detail because sustainable stock appreciation is ultimately driven by earnings power, not narratives. One thing I personally like about AMD is how the market still tends to frame it as the second option. Historically, being second has often produced some of the best investment returns when the underlying market is massive and still in its early stages. Investors often underestimate how valuable it is to be the alternative supplier in an industry where customers demand redundancy. If you zoom out and think in 5 or 10-year terms, AMD has positioned itself as a permanent fixture in AI infrastructure. It is not chasing trends, it is building long-lasting relevance. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future.